We start, okay. Okay, call the meeting to order, pledge of allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. All right, any public comment? All right, don't see any public comment now. There's something we have to read here under correspondence on all the meetings today. It's FOI meeting policy to all elected and appointed board and commissions. While a meeting is in session, the following protocol should be followed. 1, personal devices should not be used to communicate through any means, including text messages, email, instant messages, social media posts, or conversations. An exception will be made if the device is being used as part of the meeting session, i.e. a member is participating in a meeting via a phone conference. If there is a need to communicate regarding personal business during the meeting, the member should excuse himself, herself from the meeting and exit the meeting room, or request the chair to move for a meeting recess. 2, any conversations by members or questions should be addressed to and through the chair. Talking, asking another member a question, or whispering any comments to other members should not take place. At the public meetings, the public generally expects that the business being conducted is public business. Pursuant to the Freedom of Information Act, Connecticut General Statute 1-200, as amended, FOI Act, the public has a right to know what public officials say at public meetings on topics related to the public's business, unless such statements are made during a proper executed session or are otherwise exempt from disclosure under FOI Act. Failure to adhere to the business of the meeting and or the aforementioned protocols could subject public officials to a FOI request requiring the disclosure of information that may be sensitive or inappropriate for public knowledge. In addition, a subsequent proceeding could be commenced with the FOI Commission, which may result in a significant expenditure of time and resources, a fine, board or commission actions being set aside, etc. Thank you, and please keep the above in mind at all times while you are participating in a board or commission meeting. Daniel E. Carter, First Selectman. Now, voting of officers. So I guess this is the time of year that we have to vote of officers. Do I have any recommendations?
What are the officers?
Well, it'd be chairman, my position, vice chairman. I think you're vice chairman. And do we have secretary and treasurer?
No.
No. So it's just us two, I think.
Yeah. Motion that Ed maintain commission chairman.
Second.
I accept it. I guess all in favor?
Aye.
All opposed? So moved. And I appoint what Bob Crosby as vice chairman. Is the vice chairman?
Vice, yeah.
Yeah.
You need a second on that.
Second, anyone second? Okay, all in favor?
Aye.
So moved. All opposed? So moved.
Do we have anybody on, oh, we do have some.
Paul just joined, yes.
Okay. Do we had everyone's vote? Yeah.
Yeah.
All right, so the next thing is the consideration approval of the special meeting. Note, this was the meeting that we had in December. And what we did at that meeting, we approved the, what do you call it? The, trying to think of the name of it. What would you call it now?
Yeah.
The investment policy.
Yes, yeah.
Investment policy.
Sorry.
Yeah, no problem. Yeah, I guess, what we did is we considered and approved the, updated investment policy statements. And, was there a change that we had made in it? I think, was that gonna be approved too? You had an update?
Yes.
Yeah, and that was done.
Yep.
I take it. So everything was set and approved and it was passed on to the,
Yep.
to the selectmen for their approval.
Yep.
All right. Has anyone had a chance to, look at the meetings, have the meeting notes as presented?
I'm okay. I make a motion that we approve the minutes.
Okay, do I have a second?
Second.
All in favor?
Aye.
Aye.
Any opposed? Okay, so moved. Next on the agenda, is, performance review of defined benefit plan.
So we're gonna start on page 4 of the first section, the quilt. I thought I'd start with just an explanation of what the quilt is. This is kind of investment 101, but I think it tells a really good story about the last couple of years. So the quilt shows the best performing asset class, top year by year, all the way down to the worst performing asset class year by year. And the point of showing the quilt is you'll notice one of the blocks there is diversified portfolio, which, you know, the story of the quilt is a straight line sort of starts to emerge, right? You're never in the best performing asset class, you're never in the worst performing asset class. So we'll talk about, you know, sort of last year, 2025, if you guys can all go there. Who would have guessed emerging market would have been the best performing asset class due to, you know, the dollar and also the reality of, you know, the S&P 500 trading 22 times earnings. You go outside of the country, from a valuation perspective, stocks are certainly cheaper. So in 2025, if you had asked anybody in 2024 what the best performing asset class would have been, I don't think anyone would have said emerging markets. Followed by international markets. I'd say another surprise with all the geopolitical issues and wars and things going on. Surprising to see the international markets be the second best, followed by global equities, and then the United States. And looking at the quilt, I think whether you're, you know, a retail investor, institutional, or, you know, on a public pension fund, a couple of life lessons to point out. First being the reality of 2022. If you go to 2022, you might have heard me say in previous meetings, worst year in the history of the bond market. You see the U.S. fixed income drop 13%. If you remember, inflation at that time was at 11% or higher, and they raised interest rates 500 basis points, 5% in 7 months, right? 75, 75, 75. And how really, you know, painful and scary 22 was. And what if, you know, a good way to lose money is panic selling, which committees like this, you know, that doesn't happen. But, you know, selling in 2022 because of everything that's going on, life lesson, because just look at the last 3 years and the reality of the performance and how strong it was in portfolios in the last 3 years. What's important to point out in people is the last column there, the annualized volatility. The reality is that, right, when you invest, there is implied volatility. You got the blown out left tail event, you know, things like COVID, things like 9/11. You know, there are crises that nobody sees coming, where, you know, everything goes out the window. But I think investors often miss the reality of the implied volatility that we know is coming, right? So when you see a 10% drop in the S&P 500, the reality is that is to be expected. That is normal. When you don't see volatility, that's not normal. And so I think it's important to absorb that last column and know that, you know, you're going to see swings in all the different asset classes. You know, energy infrastructure, which we do not own MLPs anymore, but that was, you know, sort of the widest volatility that we did own. And the rest is self-explanatory. So summarizing 2025, right? So three consecutive solid years in a row. Take a run down the column. Finally, fixed income. We've been waiting for you're probably aware of the inverse relationship between interest rate and bond prices. And finally, that came. It was really kind of frustrating in 23, 24 to see, the bond market sort of limp out of recovery from 2022, but, really recovered nicely in 2025. Moving on, charts in focus on page 5 on the upper left. The reality is Wall Street is very bullish right now, including Morgan Stanley. And, the strategists are lining up to tell you how great this year is going to be, pointing to things like, whether it be the big beautiful bill or fill in the blank. There's a lot of reasons of why Wall Street is pretty optimistic about what's coming for the rest of the year. To the right of that, we saw the momentum stocks fade in the last quarter of last year. The NVIDIAs, the Mag 7, the top 10 stocks did still have a monstrous amount of the return domestically, but you finally saw value stocks, small cap, leadership or, real return from asset classes that, did not perform. And it was, in my eyes, refreshing to see, finally the Mag 7 sort of underperform. And the high momentum stocks started to fade. Lower left, we saw continued reduction in volatility. We saw obviously volatility yesterday, but was certainly muted at the end of 2025, and with a strong finish. Think about go back to the quilt, really across the board. Last graph to show is the active managers, particularly in the large cap space. Again, notably due to the Mag 7 phenomenon, it has been really tough for outperformance from active management. And you'll notice when Robin and I double team the portfolio is an addition of more indexes. So you can see there the decline in outperformance of active managers. Moving on, turning the page, you see Morgan Stanley. You follow Morgan Stanley, whether it be the Global Investment Committee. This is their forecast. 12% is the base return in the S&P 500. Mike Wilson, who was the head of the Global Investment Committee, is even more bullish than that, which is kind of surprising to see because he's hasn't always been that way. But there's Morgan Stanley's sort of outlook of the S&P 500 equities. And again, I think the key word is bullish. We are pretty optimistic about returns, including rates. This morning, the yield on the 10-year was 4.2. You guys know Treasury prices go up, bond yields go down. And, there's a lot of, whether it be mortgage rates, a lot of the financial industry kind of hinges and eyes wide open on where Treasury rates trade.
Mike,
Yep.
can I just make a
Sure.
comment on this chart? It would be really useful on a chart like this to see the percentage moves that are being predicted. Because,
Yep, 12% is, I hear you.
I can sit there and do the math, but it's.
Yeah. Yep. So this morning, the S&P 500 was 6796. And that's the only one I wrote down other than rates. But yes, I appreciate that,
Yes.
Myra. And come on down below, oil. I mean, the reality is that the oil prices are low, and we can debate that all day long. But it's to the consumer, it can be a really big deal. With that, I'll hand it over to Robin to dig into the portfolio and the change. By the way, expenses now are 54 basis points all in with the new structure, both with the OCIO.
What was it?
61, 54.
That's a good drop.
Yep. So that's where we head into the year with the all-in investment expenses at 54 basis.
And that's not what, about 64 million or
Yep.
something? Somewhere in that area.
Page 7 shows the asset allocation for the employee's pension. So the pie chart on the left is the actual allocation as of January 12th, when we ran this. And on the pie chart on the right is just the static target allocations. So, you know, everything Mike just said, it informs you how we're positioning our portfolio. We are intentionally overweight equities right now. So we purposely bumped it to 56%. And then the market will take that where it takes it. But we wanted to start the portfolio slightly overweight equities, given our view for the coming year, and slightly underweight fixed income. We do now have that dedicated 2% position to cash, just to kind of, you know, keep the volatility a little bit lower. So that's in the IPS, and that we will keep that dedicated allocation to cash. On
Another question on that, if rates were to go dramatically lower, or short-term rates were to go dramatically lower, would you consider reducing that allocation to cash?
Yes, we could. So it's, well, I think there's, the language in the IPS is intentionally a little squishy. So it says a target of 2%, you know, so I think we do have the ability to go lower.
So on a tactical basis, you could lower it.
Exactly.
On the bond portfolio, are we lengthening our maturities some, or are we keeping them relatively short?
We're keeping them, the firm has been lengthening a bit lately, so that has been the position of the firm. We're very neutral to benchmark in this portfolio.
Okay,
So we're targeting, you know, the duration of the ag, essentially. Page 8 is the summary performance page. So I think you've seen this page before, but I'll just walk through it quickly. So there's columns, you know, on the far left is year to date. Oh, that's only for a week or so. And then the next column is previous year, and then you'll see last 3 years, last 5 years, and then performance inception to date. So the top couple of rows are inflows, outflows. And then if you go down to the, you know, third gray bar, you'll see the return net of fees. So that's kind of where you want to focus in on the net of fees, net of all fees, advisory and managers. What's the performance of the portfolio? And then below that, there are a number of benchmarks so you can compare it to. So we'll look at previous year. So 2025, the portfolio was up 11.43% net of all fees. And then below you can see S&P 500 return, you know, the world did better because international equities outperformed US for the first time in a long time. Then you see bonds, 7.3%, REITs, and cash. I want to point out a new line that we've added, which is a static benchmark. So it's the Town of Bethel Employees Index, and the composition of that is listed below. So this will never change. We're going to just show you this as sort of a North Star benchmark. You know, we're going to tactically do what we do, but we just want to show a benchmark that never changes so you can see, okay, if we're in that always, what's the comparison to your portfolio? So that's 55% global equities, 38% bonds. You know, it's essentially your targets, 5% REITs, 2% in cash.
So it's right out of our IPS target allocation.
Exactly.
Yes.
okay.
And just, so these current periods going back, so it's that first, you know, white row up below the performance. So going all the way out, this isn't really fair because Mike wasn't, you know, working towards this target all these past years. However, he still beat it over a long period of time. And you'll see over the long history, 7.79% is over the long term still achieving your target range. Yeah, beating your 6.5. So that's our first priority, is to protect the pension, meet your target rate of return, you know, increase the funded status. And, you know, we'll use a lot of different strategies to work towards that. But that's always the long-term goal.
I found the
And the targeted actuarial rate of return is
6.5. Found the file from 2002 where this plan had 8 million in assets
Right.
and a 41% funded ratio.
Yeah, I remember that.
Page 9 and 10 show you the line items of each of the managers we hold. So just to get you, starting to get comfortable with these pages, you'll start seeing them. On the left, I should delete all that stuff. It's just your account number repeated over and over. Sorry, that
Yeah.
really clogs it up. But a little bit in, you'll see investment description and benchmark. So the first row is Vanguard Growth ETF. So that's where you look for to see, okay, what's the manager? And then there's a specific benchmark under each of those that compares to that manager. And they're organized by style, as sub-asset classes. And then, moving your eyes to the right, you'll see how much is invested in that as of 1/12, the percentage of the portfolio. And then finally, beyond that, you'll see the performance. Now, there's not going to be much performance here because we just put these in. So all you see is year to date, a week and a half. But
Robin, when did the manager turnover actually occur? Was it before year end or after year end?
it was after year end. It was,
So it's in the year, it will be in this year to date numbers.
yes.
So the first two categories are really new this year. You
Yes.
just hired these managers in this
Exactly.
position.
So in large cap growth, we have more exposure to a passive index, Vanguard Growth, and we have a smaller exposure to JP Morgan large cap growth. That's an SMA, and they're a very, respected large cap manager. They've done well for us, so that's our choice in this category. In large cap value, we also have passive exposure, but then we have two active managers. Boston Partners Large Cap Value and Columbia Dividend. We like the pairing of these two because Boston is a very typical sort of discount value stock picking manager. Columbia Dividend is different. They're focused on growing dividends, which that Venn diagram of dividends to value, there's overlap, but they're not the same. So they actually do, we like that there's sort of different expectations for performance for those two managers. Fuller Thaler Behavioral Small Cap Equity. This was one of the managers we maintained. So you've held them for a long time, which is why you see long-term performance history. And they've been great.
Robin,
Uh-huh.
the tilt towards large cap growth versus value is based on what?
It is intentional. The S&P 500 is largely growth now. It's like 60
It's
to
happened to the
40.
index. Yeah.
Yeah. Right. So we're still think large cap growth will do quite well. So we're overweight both, honestly. We're overweight growth, we're overweight value, a little more overweight growth. Then we'll get to the international managers. And we also have passive exposure. And then we have two active managers. You've held Causeway for a long time. They're a fantastic value manager. And then we added MFS International Equity, which has a bit more of a GARP sort of growth tilt. So, when growth's out of favor, so similarly, these are good pairings because they have different tilts in the international space. Then moving below, we have 5% in emerging market equities. Again, it's split actually mostly passive, 3% passive, 2% in active manager Clearbridge emerging markets. They used to be called Marks & Curry and recently changed their name. And then you get to the bond managers. We have Federated Amis Core Bond and Luna Sales 4+. So the plus means they have a bit of a wider mandate. They can have some in high yield. They can have a little sliver in sort of more higher yielding securitized bonds. It's not a huge amount, but we do like that optionality, which is why we have half in just a core manager and half in a core plus. Then next we have the Vanguard REIT ETF, which we really like. We kept that. You've held that for a long time. And then below you see the cash. And so this is now how you will see the managers laid out going forward, just so you get comfortable with how this page looks.
And the cash you keep in what form? Money markets or?
Yes, so there's the Federated Hermes Government Obligation Fund. That's the money market fund that we have. And then the cash right there that you see 126,000, that was preparing for the payment of the benefit payments, which happens around the 20th of every month.
Yep.
So that had come in the portfolio around the 12th. And if I had run this the next day, it probably would have been in the money market, but it just shows as cash at the moment. So we do sweep into a money market automatically.
Right, so we have an independent third party, first stage who's making the monthly payment. So we wire money on a monthly basis and it gets linked out to all the participants, tax withholding, et cetera.
And the final
Well,
page.
the
I'll-
money markets are not insured money markets. They're just regular money markets. Price a dollar, price dollar,
NAV dollar.
Yes, I
NAV dollar. Yeah, they're not FDIC insured money market,
think they are.
or are they?
I think they are.
Because they usually pay a little less if they're FDIC.
I'll
Versus
check on
just
that for
the-
you.
Yeah,
Let me get back to
because I
it.
know we have options in our investing with our groups that we do.
Yeah.
And we have some insured which pay less and then some non-insured.
A lot of our cash reserves that are outside of the pension right now are in, I forget what they call it, but in essence, the bank, like if Union Savings halves it, they send it to 50 other banks. So each bank has like $240,000. So you get the insured, and they have all these agreements now.
Right.
We have that agreement with Unions, any money we have with Union Savings and the Newtown Savings Bank.
Yeah.
This is what, I don't know who created it, but it's smart. So pretty much they're just sharing the risk and sharing money.
Yeah. So you got that 250 cap per
Yeah.
account, per bank account.
I'll check on it. And finally, page 11 is just another way to look at the portfolio. So it's just an asset class performance. So what it does is roll up all of your, equities. So if you just want to see, okay, how did the equities do alone? 2.73 year to date. And then just below that, 2.35 is the MSCI All World. So it's just a rolled up way to look at everything. If you want to see how any sub asset class did against that respective benchmark. So there's just a lot of different ways we look at the portfolio and we'll monitor it for you. And so this meeting, we don't have much to talk about just because we just implemented. But over time, whenever there's a trade, we'll explain it to you and why we did it and what we're thinking, moves we plan to make.
So Robert, do you have an estimate of the costs to us of the turnover in the managers? Since, we turned over what, 70% of the portfolio roughly? Or no?
Yes. I don't have that with me, transaction costs, but what Mike brought was the change in the overall fee,
Right,
the manager fees.
right.
But no, I don't have
I mean, I know it's a one-time deal. It's just,
Yeah. I don't. But I can get that.
Thank you.
And here again, the concept of all this is to spread the risk, basically.
Exactly.
Bring down the data.
Yes. Yes, we want to have a well-diversified portfolio and, not everything's going to move.
Only
down the same.
mathematical way to reduce risk,
Yeah.
diversification. You want to go over two? Two is the same as, tab two is the same.
Switch to the police.
Yeah, okay.
What's the town, the police.
We can skip past the market slide. So page 7 of 24.
Mhm.
It's going to look very similar because as we discussed last time, these are starting out with the same allocation. They have the same managers, but the police pension is now at 24,400,000. And again, it intentionally has a slight overweight to equity and slight underweight fixed income. The next page 8, you'll see the performance page again. Probably nearly identical. The police pension was up 11.43% last year. And over the long term, very similar, 7.77 annualized.
Mhm. Very similar. And it's the same strategy.
It's the same. Yes.
Yeah.
It's just in that bucket of money that you keep separate.
It's a smaller amount, yeah.
And on the third, the LoSAP is now has the exact same allocation. Right, so whatever OCIO in conjunction with my team, we're just gonna follow through. So you'll notice when they make a change, we're gonna make a change. The large distribution is gonna be coming, Brad, in February, because it was February 10th, I believe, last year.
Yep.
So we're gonna get another request. I know it says 82,000.
Yep.
It was 100 because we had a cash account.
Alright.
So that didn't pick up in this report.
Yep.
Fingers and toes crossed, it doesn't go up again, but, here's where I think.
Yeah, so just so, so when I'm building the budget, which I'm doing now, the next year, I have a line item in the budget now to start funding LoSAP at $50,000 a year.
Oh, okay.
So for the longest time, like if you look at the performance from inception, the investment earnings were $150,000 more than what was coming out. So we weren't adding anything. But it's time that we start budgeting for it again,
Mhm.
So that's kind of where we're at.
And the budgeting will be separate from what the investment earnings could be or will. be.
Correct.
Yeah.
Yeah, because we're not gonna say it's 100 again this year. Our plan's not to put 100 in
Right.
this year, it's to put 50 in because we got to build it back up into the budget. And because that's a locked group, it's gonna spike for a while and then eventually tail off somewhat.
And like
Yeah.
just this is entirely passive within the asset classes?
Not entirely, mostly. We tried to get the same manager either through ETF or a mutual fund if it's available. So like the Vanguard Growth is the Vanguard Growth, right? The JP Morgan is the JP Morgan. It's almost identical.
Oh, so you're doing all the active managers?
Yes, yeah, we're trying, right, if it's
Yeah,
available.
Such a small amount, I just wonder if it's worth it.
Right.
But they look at.
Well, it's not an SMA, it'd be the fund version,
Yeah.
the institutional fund version. So,
Oh,
yeah.
Could I show my newcomer ignorance by
Yeah.
asking what LoSAP is?
It's a great question. So it's the length of service appreciation program for the 2 volunteer firehouses in the town. So it's not a traditional pension plan. It's a reward plan based on criteria that each of the volunteer firemen have to earn. And that the maximum amount is $300 a month. If you,
You got to be an active firefighter for like 25 years to get the $300 a month, and you don't get it until you turn 65.
Wow.
So we've had a couple people claim it recently. We had one guy that should have claimed it like 8 months earlier, and then he passed away. So we had the spouse file for it. The plan paid out. He wasn't qualified for 300. I think it's like 260 or something like that. So the 8 months that he was qualified, the plan paid out the 260 times 8, but then he's done. It doesn't go to
No
surviving
survivor.
spouse. There's no,
Oh, okay, no joint survivor or anything like that.
yeah, no, and it's locked. So, wow, what was it, 14 years ago?
It was a while ago, yeah.
That- yeah.
There's no new members coming, even though you have new members coming into the fire departments,
Thank goodness.
they can't join this program.
this is a frozen program.
Yep.
And grandfather, back to when all this was put together.
Yes, 14, 15 years ago we did this.
Yeah, surprising that, seems like it was yesterday.
I know.
Mr. Chairman, it might also be helpful, Steve, to know that the employee pension plan is a frozen plan.
Right.
Town employee pension plans. I'm addressing. the
For new
chairman,
hires,
that's what
yeah.
you just said.
Yeah, I know. Yeah, that is frozen. It was frozen. How many years ago now?
I think 2016 was
Yeah.
the last in the contract for the employee side. Police
Right.
police new hires still have a pension.
Yeah, police are still active, but yeah, about 10 years ago now.
Example, 403B or 401K or both.
Oh, is that right?
Yeah, so now it's anybody hired after, it depends on the union. They go into a DC, a defined contribution plan, which is either 6% with a 6% match and a 5-year vest or a 7 and
Right.
7.
Oh,
So the town plan actually is a phase out plan now.
I see.
So as the years go by,
Yeah.
You know, the amount of money will eventually start going down.
Right.
And, you know, in the next 40 years or whatever it takes, it'll disappear.
Yes, you'll notice the amount of money going out is significantly more than what's coming in, which is what's supposed to be happening. So there's an end to this, you
Kind
know,
of
this
like the
bit.
private sector,
Yeah.
Very similar,
getting rid of 401k.
very similar.
Right.
Very similar.
And the matching contributions and all that.
The reason why it wasn't done in the police department area and that we kept the plan there is because of the competitiveness of other towns and
Oh,
the fact that,
oh, I
you
see.
know, if we had tried to do it, we might have lost our, part of our police force.
Ah,
Yeah.
Yeah, exactly. It
So-
would not have been competitive.
So if you look at page 8 in the town, if you look at like the last 3 years, the net contributions and withdrawals for the town side was a negative 3.8 million. That same period, it's 1.2 up for the police.
Right,
Or all the new members are contributing,
right, right.
so.
right.
And it's just a smaller group too, but for now.
Interesting.
Yeah, and I think the police have different retirement protocols too.
So the town pension right now is you get, for every year you work, you get 2% of your 5-year average when you retire, assuming you qualify. The police plan is 2.5% for the first 20 years, and then 2% a year after that. They both max out at 70% of pay. It's all based on base pay. So like some neighboring towns that are in the state plan, the MERS, it's based on with overtime. Ours is not. It's just base pay for the police. The police contribute 7.5% of their base pay. The town employees contribute 6%. And you have to qualify for it. So for the police, you have to do at least 10 years and be 55, or be 25 years. There's some early retirement options with the other. And on the town side, to leave and take it, you need to be the rule of 75, age plus years of service.
So
Equal
the
and 75.
town plan is not actually frozen, it's just closed to new entrants.
Right, close new entrants.
Right.
Yeah.
But they're still accrued. Those who are eligible are still accrued.
Right.
Yes.
Right.
Don't get any
It's just
ideas,
that
Myra, something.
No.
You guys go.
And then the 401k
I am a
plan.
great believer in defined benefit. Despite the accounting.
And the 401k plan that is in for the town now, has been there for going on 10 years. The people contributing to that, that's mandatory, I think, isn't it?
Correct.
For all the
So
employees.
in the contract, we made it mandatory, even though it cost the town more money because if somebody opted not to do it. But we thought it was in our best interest to protect the employees to make them mandatory.
Right.
So,
And there's a mandatory contribution that you do,
yeah,
and then they can match it or do what they want up to the limits.
so the only thing with their current defined contribution plan through VoIP is whether it's 6 or 7%, they have to put in 6%, and then we put in either 6 or 7, depending on what they're doing.
Right.
The clerical union in their latest contract, which just got finalized in the last couple of months, all new hires are 7 with a 7% match. The current people that were 6 get one time they can go from the 6 to 7. Just because it is even though 2% will go in, it is a 1% reduction to their take home. 0.9, whatever, net of taxes. But you know what so at some point, in theory, all those people will be at 7. But we did give them the chance to I don't want them jumping back and forth because for us, it'll be a nightmare upstairs. But we did look, when it makes sense for you, jump to the 7, but all new hires are at 7.
But this commission does not have responsibility for 401k. We just have responsibility for the defined benefit
Yeah.
plans and the rules.
But that is up for discussion, I believe,
Yeah, I don't know.
at some point.
Yeah.
Yeah, in other words, at some point, we might get involved in it, but we're not now.
Well, because at some point, there's only gonna be in essence, a police pension. So there, but hopefully there's at least one person, at least in pay status for a long time.
All righty, I guess that concludes any other discussions on the performance? Anything that you need? Before I get into the, update, so the finance, director's update. Did we submit, a calendar for, next year?
Yes.
Yeah, the last meeting.
Okay, that's what I thought. I just wanted to kind of remember. So that has been submitted.
That's
We don't have to
yeah,
go back and do that.
correct.
Okay,
So on the, obviously, we talked a lot about the pension piece. I'm gonna just talk about the insurance side, which we don't usually spend a lot of time on. So I did contact Perma this week, who's our insurance carrier for workers' comp and lab liability, auto and properties, to try to get renewal rates. We're in the second year, I believe, or third year. We have a block on our liability, auto, property. So the max that can go up is 5%. I suspect when they respond, they'll say 5% for now, and come March, April, I'll circle back to them and go, is it really 5%? Seeing how we have generators, heaters outside the building right now because we have a pipe burst. It may not be a year that they move at all when we come back on the 5%.
They've been known to do that in the past, Brett.
Yes. Yeah. We've had, knock on wood, we've had really good history. On the comp side, the last couple of years, they've actually come down. But again, we've done a lot of stuff to try to limit our claims, be it training and all like safety equipment. So we've had pretty good experience on the comp side and the lap side, but you know, on both sides, all it takes is one really bad claim to kind of blow your claim history. So we'll see what they come back with. But again, we do have a 5-year lock, 5% lock, max lock. And how we ended up there, just as a reminder, or for our new member, is we were going into the third year. I think it might have been 2 budgets ago, that we had a 3-3-3 lock, and they were going to go up 3%, but they offered us 0 that year if we tacked on 2 more years at a 5% max. So we jumped at it going, I talked to actually Paul, I called Paul as our insurance expert around here, and said, this is what I'm thinking, does it make sense? I looked at it as, in essence, we're locking up a 3.33. Yes, it's a 0 and then 2 5s. But I think if they had offered us 3 years at 3.33 max, I think we would have taken it. So in essence, I took the 0 up front, knowing that the second and third year might be 5%, but it might not be. That's just their max that they can do. So that's where we're at. And I got to look it up when I get the numbers back to them. I think we're in the second year of it, but it might be the third.
yeah, and actually, that's pretty good because, there's not a lot of competition. There's not a lot of companies out there writing it.
Correct. And I remember the conversation I had with Paul. He goes, what my customers are seeing, you should jump at a 5% block cap. So we did.
We get any dividends back?
So we got, this past year in 25-26, we got $70,000.
Okay.
So if you're a Kerma member more than, I think, 3 years, at some point, if they do a member distribution, so they distributed millions of dollars because they had a good year, and then they base it on whatever percentage your premiums are of the whole base. So whatever that math worked out, so we got a check for 70,000.
So Kermit is a mutual.
Yeah, so it's a pool. So it's the Connecticut Interlock, whatever, Risk Management Association or something. It's CCM's the Connecticut Conference of Municipalities, which is a big group for like the governing piece. They started Kerma, and it's I think it still falls under the same umbrella, but it kind of runs independently. But it's the pool. And how we ended up with Kerma, when Bob was the comptroller, is Travelers wanted a 30% increase in our workers' comp. Kerma came in at that point, they would actually still do more than 1 year. Kerma, I think, came in pretty much what we were paying and gave us a 3-year deal on it. So we jumped at it. And
Well,
Kerma
Travelers was looking to get out of the business.
Right.
Yeah.
So they figured, well, if you're gonna take it at 32%, okay, we'll take that. But
Stay in the business.
yeah,
Yeah, we're back in.
and it's only 2, right? Left?
Yeah, last time we went
Kerma?
out to bid, I think there was supposed to be 3. It was Kerma, Travelers, and Titan or something like that. And I don't even think Titan bid on us at that time. So, And we have some headaches with them because they're insurance carrier, but like, at least on a premium side, they've been really good to us. Dan fights with them every once in a while, but that's his job to fight with them. So. But
Okay.
that's kind of all I have for the finance director's update.
All righty, any other discussions? No? Okay, I have, do I have a motion to adjourn?
I'll make a
Okay,
motion.
second. Okay, seconded. Okay, all in favor?
Aye.
Opposed? All righty. So
Thank you.
fast.
Not too bad.
Oh, hold on.
Yeah. You need those things. Didn't have them.